This is a certified fraud examiner bringing to you latest scams that may impact you. Let's learn how to avoid and recover from them. Three scams in today's report appear to have very different stories. One begins with a cell phone sale, another begins with a supposedly compromised computer, and third begins with a shocking Apple Pay transaction. But underneath those different stories is the same fraud objective: get the victim to trust the criminal long enough to surrender information, give access, or move money. The important question is not whether you have heard of these exact scams before. It is whether you can recognize the mechanism when the story changes. The first case begins with something that normally sounds routine: a sales call from a cell phone company. Police warned residents after several people were targeted by callers claiming to represent reputable cell phone providers. The caller's objective was not simply to sell a phone. It was to collect personal information. That information was then used to purchase cell phones that were shipped to other address. The victim was left with the bill. This is important because the fraud does not necessarily require the criminal to steal money directly from a bank account. The criminal can instead use victim's identity as the financing mechanism. There are several warning signs. First, the contact is unsolicited. The victim did not independently initiate the transaction, yet the caller is asking for information that can have financial consequences. Second, the caller relies on the reputation of a legitimate company. The name of a newer company can create trust without proving that the person making the call actually works there. Third, the consequence is delayed. The victim may believe the call was simply a sales interaction. The fraud becomes visible later, when the device has been purchased and delivered somewhere the victim does not control. That delay can make the original conversation harder to remember and the fraud harder to reconstruct. The most important red flag is therefore not the product. It is the combination of unsolicited contact, identity information, and a transaction the victim did not independently initiate. And that brings us to prevention. A legitimate company can be contacted through channels that you control. The caller does not control those channels. So if someone unexpectedly calls offering a cell phone deal and asks for identification or banking information, end the conversation. Then contact the company yourself through a trusted website, statement, or existing account. Do not use a number supplied by the caller simply because it sounds official. The same principle applies beyond telecommunications. An unsolicited caller asking for sensitive information is asking you to accept their identity claim before you verify it. That reverses the normal order of trust. Verify first, share information second. In the reported cases, phones were purchased using victims' information and sent to different addresses, creating a clear transaction mismatch. If this happens, contact the provider and relevant financial institution immediately. Dispute unauthorized activity. Secure compromised credentials and report the fraud to the appropriate authorities. But the next scam goes further. Instead of pretending to sell you something, the criminal first convinces you that something has already gone wrong. Then another criminal appears to help fix it. The phantom hacker scam is structured as a sequence. The first criminal poses a technology support representative. The claim is that the victim's computer has been compromised. The conversation then moves toward the victim's financial accounts. The supposed technician may say that suspicious activity has been discovered and offer to connect the victim with the financial institution's fraud department. That is the first transition. A second criminal takes over, impersonating the bank or another financial institution. Now, the original technical problem appears to have become a financial emergency. Then, in some cases, a third criminal enters the conversation. This person claims to be a government official or another authority figure. The victim is now surrounded by apparently independent sources confirming the same story. But they are not independent. They are parts of the same fraud operation. That is the central mechanism. The criminals manufacture corroboration. Each new identity makes the previous claim appear more credible. The psychological pressure also changes. At the beginning, the victim is worried about the computer. Later, the concern becomes bank account security. Finally, the victim may believe that retirement savings or other assets must be moved immediately to prevent criminal access. The destination is described as safe or protected, but the money is actually being transferred to the criminals. There are several red flags. An unsolicited person asking to access your computer is one. An unsolicited person asking to review financial accounts is another. And an instruction to move money because a government authority says it is necessary should be treated as a major warning sign. So should any demand that the victim keep the supposed investigation secret. The FBI's reported figures show why this mechanism deserves attention. More than 47,000 technology support scam complaints were reported in 2025, with reported losses exceeding 2.1 billion. People aged 60 and older accounted for approximately half of reported victims and losses. The scale matters because this is not simply a strange phone call. It is a repeatable fraud model. The prevention strategy is to break the chain. If someone unexpectedly claims that your computer or bank account has been compromised, do not let the person become your verification source. End the call. Open the institution's official website yourself. Use a trusted telephone number from an account statement or other existing documentation. And do not give remote access to a computer because an unexpected caller says it is necessary. Most importantly, legitimate financial protection does not require you to surrender control to an unknown caller. The FBI's IC3 report over 2.1 billion in losses from more than 47,000 technology support scam complaints in 2025. If targeted, contact your financial institution immediately, secure affected accounts, report the incident to local law enforcement, and submit relevant information to the appropriate National Fraud Reporting Agency. The third case looks shorter. One text message, one alert transaction, 35 minutes to act. But that countdown is precisely what makes the message dangerous. The reported victim received a message claiming that Apple Pay had already charged $8,250. Then came the second warning. Another $8,250 transaction was supposedly be approved in 35 minutes. The implied exposure was $16,500. The message instructed the recipient to call a supplied number and use a case reference to cancel the pending transaction. This is a classic callback structure. The text itself is the bait. The phone call is where the criminal can begin collecting information or directing the victim's actions. The first red flag is the deadline. A precise countdown creates a conflict between two behaviors. One is careful verification. The other is immediate reaction. The scam is designed to make the second feel necessary. The second red flag is impersonation. The message uses Apple Pay branding and an official sounding service name. But branding is not authentication. The third is the language. The alleged account is described in dramatic terms, and the recipient is told to take an unusual action to kill the pending transaction. The message is not simply communicating information. It is directing behavior. The fourth red flag is the contact path. Instead of telling the recipient to open wallet or contact the bank through an existing channel, the message directs the recipient toward the number supplied by the sender. That is the critical point. The person creating the emergency also controls the proposed solution. There are contradictions as well. The message reportedly claimed that contactless spending had been blocked, while simultaneously warning that another contactless transaction would automatically proceed. A legitimate financial alert should make the transaction history easier to verify, not harder. The correct response is therefore simple. Do not call the number in the message. Open the wallet application, check the relevant card. Then check the bank or card issuer's official application. If something still appears wrong, use the telephone number printed on the physical card. Do not provide a verification code to someone who says the code is needed to cancel fraud. And do not install remote access software because a caller claims it is required to protect the account. The objective is to move the verification process away from the scammer. The reported message combined a 16,500 threatened exposure with a 35-minute deadline and a callback funnel, while the payment story contained internal inconsistencies. If contact has already occurred, secure the affected financial and account credentials immediately and preserve evidence before reporting the incident. Across all three cases, the technology changes, the underlying fraud mechanics do not. An unexpected caller creates the first point of contact. A trusted brand or authority creates credibility. Urgency reduces the time available for verification. And the final instruction gives the victim a path controlled by the criminal. That is why the strongest defense is not memorizing every scam. It is recognizing the sequence. Pause when the contact is unexpected. Verify independently. Protect your personal information. And if something has already happened, act quickly to contain the damage and report it. A scammer needs you to remain inside their version of events. The moment you leave that conversation and verify through a trusted channel, their control becomes much weaker. Thanks for joining me. Remember to subscribe for the next update. Thank you.